A company can run out of truth before it runs out of headlines. In 2001, Enron became the name people used when numbers no longer meant reality, and 20,000 careers were left carrying the cost. The strangest part isn't that it collapsed. It's that so much confidence survived right up to the edge, as if the warning signs were written in a language only insiders could read. Every public claim sounded precise. Every assurance sounded temporary. Every alarm sounded late. So where did the value go when the lights were still on and the paperwork still looked complete? The money didn't vanish. It was never there. That question is the engine of this investigation. To answer it, we have to rewind to when the model looked legitimate. A pipeline business evolving into an energy market intermediary, where real innovation and dangerous incentives first learned to coexist. And that's where the rot began. In 1985, Houston Natural Gas and Internorth merged to form Enron, and the strategic premise is straightforward. Deregulation is changing how gas is bought, sold, and transported. Leadership sees a narrow pipeline operator as a declining model. The new ambition is to become a market maker, a financial intermediary that stands between producers and buyers, prices risk, and captures spread. Inside that vision sits the early gas bank logic. Treat contracts not as static obligations, but as tradable positions. At this stage, the innovation is not theater. It addresses a real inefficiency in a rigid market. Enron then helps build the first natural gas spot market, unlocking value trapped in long-term fixed-price contracts. That move gives the company intellectual legitimacy and cultural momentum. The internal doctrine is often described as asset-light, profit from information, structuring, and risk transfer, rather than from owning more steel in the ground. In that framework, physical infrastructure becomes a platform, not the endpoint. Executives increasingly view Enron as a capital allocation machine, prioritizing financial efficiency over operational weight. For a moment, the thesis looks coherent, even disciplined. This is the uncomfortable truth at the center of the case. The origin is not pure fiction. Real innovation creates real credibility, and credibility lowers resistance to complexity. The mythology of being the smartest operators in the room does not begin with fraud. It begins with success. But when a system built to intermediate risk is also commanded to grow without pause, what exactly gets optimized first? Market function, or the appearance of perpetual performance? $74 billion is the scale attached to the collapse. But the decisive break happens earlier, when Enron stops treating energy trading as the destination and starts treating almost any uncertainty as something it can package, price, and report. Broadband capacity, weather exposure, long horizon promises in markets with thin liquidity. The thesis sounds sophisticated. If risk can be modeled, it can be monetized. The control failure is subtler. Models begin to outrun markets, and accounting begins to outrun cash. At the cultural peak, Enron is celebrated by Fortune as America's most innovative company for consecutive years, and its headquarters projects openness while internal visibility narrows. Mark-to-market accounting becomes the core mechanism. On long-dated, illiquid contracts, the company can book estimated lifetime value at signing, pulling expected future earnings into the present. In principle, that method can match economics to reporting. In practice, when assumptions are difficult to verify and external prices are scarce, discretion expands. Reported performance becomes increasingly dependent on internal judgments rather than realized operating outcomes. The metric that governs behavior is earnings per share momentum. Beat expectations, protect the multiple, defend the narrative. That pressure changes decision quality. Instead of asking whether a market is mature enough for reliable pricing, leadership asks whether the structure can sustain near-term earnings optics. Innovation shifts from solving customer frictions to solving valuation demands. And once valuation depends on projections behaving like facts, missing targets is no longer a setback. It is an existential threat. So what happens when reality finally refuses the script? The hedge is supposed to absorb shock. At Enron, it amplifies it. Special purpose entities, structured through Enron's finance operations, are presented as independent risk buffers. But the core protection is Enron's own stock, pledged as collateral against losses. That is not insulation. That is a fuse wired to the dynamite. If the stock weakens, the hedge weakens. If the hedge weakens, liabilities slam back onto Enron. The entire system is engineered to survive only one condition: a rising share price. Enron's finance leadership profits personally from these vehicles, while the company depends on them to defend reported performance. The control failure is structural. Governance treats form as substance. Documents show separation. Economics show dependence. The same architecture that masks volatility also concentrates it, quietly, in places investors cannot see. Then, the trigger. In August 2001, the CEO departs. Scrutiny intensifies. Wall Street Journal reporters begin pressing questions about the SPE structures. Confidence slips. The stock declines. And contractual commitments buried inside the vehicles begin to activate. What was designed to look like insurance starts behaving like debt. Exposure parked off balance sheet forces its way back. After the collapse, the SEC charges Enron's former chief accounting officer Richard Causey in a scheme involving false and misleading financial statements. The complaint details manipulation across 10Qs and 10Ks, overstated revenues, understated debt. The blind spot is now unmistakable. This was a wager against correction itself. In weeks, a digital run on the bank begins. Counterparties freeze. Credit lines vanish. The question changes entirely. Not what is Enron worth, but who gets trapped first when trust evaporates. The failure stops being abstract the moment payroll ends. Approximately 20,000 employees lose their jobs, and many who trusted the company for decades watch retirement balances collapse while liquidity windows favor insiders. The legal structure fails fast. The human damage compounds slowly. Mortgages, tuition plans, delayed retirements, and reputations tied to an employer name that now signals risk. A collapse measured at $74 billion does not end in bankruptcy court. It migrates into households, resumes, and labor markets that suddenly price association as liability. Institutions respond with force. Enron's auditor, Arthur Andersen, is convicted of obstruction of justice, and the firm collapses. Congress then builds a new oversight architecture in the Sarbanes-Oxley era, including the Public Company Accounting Oversight Board, created after Enron and WorldCom to replace self-regulation in auditing. The doctrine shifts from trust in professional norms to enforceable inspection, documentation, and sanction. Markets absorb a second-order lesson. When disclosures are difficult to verify, complexity no longer earns automatic admiration. It earns a discount. That framework remains unsettled. Contemporary reports show the SEC debating a specialized enforcement unit aimed at fundamental audit failures, while investor advocates warn that expanded SEC action could hollow out PCAOB enforcement. Regulators acknowledge overlap and say the new approach targets incompetent auditors and clear professional standard violations, not a replacement of the board. The dispute sounds procedural, but its origin is structural. Who watches the gatekeepers, and what fails first when oversight itself becomes fragmented? The final diagnosis is not bad accounting. It is an incentive singularity. A compensation system so concentrated on reported momentum that fiduciary judgment loses practical authority. In that environment, caution is punished. Doubt is reframed as disloyalty. and internal challenge becomes a resignation letter waiting to happen. The $74 billion collapse and 20,000 shattered careers are not a separate event from that design. They are its downstream output. The hidden presupposition is the liquidity delusion. Enron behaves as if there is always an external market deep enough to validate internally modeled value, and always enough confidence to refinance complexity. But internal marks are not external cash. They are IOUs written in a currency only Enron believed in. And engineered resilience is not true absorbency. When governance depends on the same people who benefit from optimistic assumptions, ambiguity stops being a technical issue. It becomes a harvesting tool, one that systematically weaponizes the gray zones of rules that exist but carry no teeth. Post-crisis policy debates reflect that lesson. Economic enforcement frameworks increasingly stress penalties tied to demonstrated harm, not headline size alone, because deterrence fails when sanctions ignore mechanism. Current oversight debates around auditor enforcement and regulator overlap echo the same control question, not whether standards exist on paper, but whether independence survives pressure when the stakes rise. The strategic warning is portable. Any firm can report innovation. Fewer can prove that earnings quality is independent of valuation maintenance. The difference between the two is where the next Enron hides. So the closing test is simple and severe. In your portfolio, where does innovation become indistinguishable from financial engineering? And who exactly can still say no when it does?